Special counsel, please call the roll.
Director Pacio,
Here.
Director Scholas,
Present.
Director Antrim, Director Kennedy. Here. Director King. Ms. Shawn.
Here.
Ms. Johnsy. Mr. Magbu. Mr. Joseph.
Here.
Chair, we have a quorum.
Thank you. We'll proceed this morning. We have three presentation items. Kwaku from, from Marquette. Excuse me, but
Glitch in the system there.
one of the senior moments. Kwaku from Marquette will present the asset manager candidate presentations. Fixed income, core plus, mid-cap, and also, I think, international small cap. Is that correct, Kwaku?
Right. There's also international emerging markets as well.
Okay.
And international small cap.
Okay, would you please proceed?
Absolutely. So good morning, everyone. And I think the goal here is to reach a consensus on the managers that we interviewed. I'd say with the exception of small cap, where it does appear that, a blend of the two managers that were interviewed, that could actually work for the portfolio. I think we're looking for one manager in each category. That way we maintain, passive exposure, which helps with the cost management of the program, also helps with control and tracking error. But then we also have some active managers, which should hopefully lead to outperformance over time, but then downside protection if the market sells off. So with those two goals in mind, just a quick recap.
A question.
Yes.
Which small cap?
Domestic small cap. So I will
Yeah, so-
make a point of saying domestic small cap and then international small cap. So there's no confusion between the two.
So if we would consider both that presented, would that be a problem in that particular area?
So from Marquette standpoint, that wouldn't be a problem. Now, there is a organizational update, and we do have a memo on that for you. And
You'll get to that.
yeah, so
Okay.
I'll get to that. And if you want, I can get to that now.
No,
just
take
so-
it in
Yeah?
order.
Okay, so we can just take it in order then.
Yeah.
Okay,
Mr.
so-
Chair, Ms. Johnsy has joined the meeting.
Morning.
Thank you. Thank you.
So as we go through the various asset classes, what I'll do here very quickly is just pull up the market values for the portfolio, so we just get a sense of the dollar amounts in question. So for fixed income, we interviewed two managers. One was Loop Capital, one was Ramirez. I would say that all of the managers that we reviewed, these are top managers, right? At the end of the day, we think all of the candidates are strong. They bring, strong attributes to the portfolio from a performance standpoint. In terms of ownership and location and other, we call them aspirational goals. Some managers, I think, check boxes, others do not so much. So that's also something that I just wanted to mention. But as we think about the managers and everyone that's presenting, everyone is a solid candidate. So wanted to start with that. From an investment standpoint, you're looking at very good managers that should do right by the portfolio. So with that, on the fixed income side, we have Loop Capital and we have Ramirez. I know, just quickly debriefing on the two candidates that we went through, both of them have exhibited very strong performance relative to the benchmark. One of the big differences between Ramirez and I'd say other managers in this category is their use of municipal securities. I think that was an area that, some of the trustees dug into a little bit more. And then with Loop, Loop was more of your typical core plus manager. So I think that's where, the conclusion lay with the two managers. With Midcap, we had Madison and Ernest Partners. Again, Madison, good firm. Ernest Partners, also a good firm. Ernest is already an incumbent in the portfolio. They do manage a allocation in the non-US large cap space, so I think that's advantageous to Earnest in the sense of you already know them. That can lead to fee negotiations and so on. Earnest, from an ownership standpoint, well, both managers are independently owned, but Earnest is the diverse owned candidate. Both Loop and Ramirez diverse owned. Ramirez being Hispanic, Loop being African American. On the small cap side of things, Mesirow is a majority owned firm, but the leadership of the strategy is diverse. Performance for this strategy has been good over multiple market cycles. Channing, an African American owned firm, this is more of your higher conviction, more concentrated portfolio. So the notion of pairing up Channing with someone else, I think is reinforced by the different styles of the two managers. On the international side, both GQG and Causeway, solid managers. When we think about complementing the index exposure, both strategies do a nice job. With GQG, this is a diverse-owned firm, South Asian. Causeway, also independent. There's female ownership that helps Causeway's cause, for lack of a better term. And then on the international small cap side of things, we have SGA and TS&W. TS&W, that's a strong firm that we know exceptionally well, based out of Richmond. SGA, also a firm with a nice track record, tilting more towards the quality side. So with SGA, there have been periods where the strategy may have lagged the benchmark a little bit, but again, a good long-term track record. And looking at female ownership when we think about the ownership structure. So that's the high-level overview of all the managers. And again, really want to stress here that every candidate here is a solid candidate. At the end of the day, I want to pause and just get feedback on how you guys would like to commence with the rest of the discussion. We have numbers, we have analytics from the prior meetings, just in case there's any questions over any of the candidates that we went through. And then with respect to making a decision, again, I will give deference to you all and your procedures and process with respect to how you'd like to put forward candidates to move forward with or discuss further.
So the only one that we're going to do two is going to be on small cap,
Yes.
but
domestic.
all the rest of them, we're going to have one candidate.
That is correct.
Okay, so small cap two, and the rest of them we have to pick one. All right. And then when we did these, I'm trying to remember who was there was one of these that was a standout in the actual interview process. Well, all else was equal, they were actually really good when they came and talked with us. And I'm just trying to remember which one was that between the Mesirow and Channing. But we're taking both of them, so it won't matter. Correct.
So, yes, that's
Mesirow is
correct.
already in our portfolio,
Yes, they are. Yeah, they are.
and they outperform Channing quite significantly.
Correct. So Channing is going to be that, yes, it's that high conviction strategy. So they're going for long-term results, but those long-term results can come with tracking error. Your Mesirow is more of your steady manager throughout the full market cycle. So that's where we're looking to complement a more concentrated manager like Channing with someone like Mesirow that's good across all cycles. That's correct.
I'd like to see if there are any questions from committee members regarding each of the asset manager candidates. And then Quaco proceed with the recommendations from Marquette. But I need you to provide the update from the memo you received, just so that the committee members are clear on what's happening with small cap and Mesirow.
Yes, absolutely. So since we last met, we were informed that Mesirow is selling off its traditional business. So Mesirow has an alternatives business, private equity, real estate, and then it has a traditional business. So you can think about equities and fixed income. So they are selling off the traditional business to MetLife. MetLife, the insurance company, has a very deep bench on the fixed income side, but they have less of a bench on the equity side of the business. So what started out as an initial discussion on just distribution of retail funds and increasing Mesiro's distribution led to a transaction where Mesro is now selling off its traditional business. The small cap strategy that we met with and interviewed with, that will be part of the transaction. We view the transaction actually as a positive thing when we think about MetLife being a bigger organization, bigger resources, and then ultimately the team, Leo Harmon, that you met with, it gives Leo that much more buying power and that much more say within a larger organization. So the small cap team from Mesirow will remain intact. They're not moving anywhere. We are placing them on watch just because it's an organizational change. But again, we view the transaction as a positive thing. So we don't view it as something that should prohibit us from moving forward.
Moving forward.
Mesirow.
Can you also just give us an update of what this means in terms of performance? It doesn't necessarily change that aspect of their role.
Correct. So from a performance standpoint, we don't expect any changes. The team remains together. The team is not moving to New York. They're remaining in Chicago. And really, we're viewing it as a change in banner where, someone gets traded out from a team, they join a new team, the same type of framework. At the end of the day, Leo, his team, the track record, the infrastructure that's built this portfolio will essentially remain in place. And acknowledging that MetLife didn't have an equity presence, someone like Leo is actually coming in with the red carpet rolled out for them at MetLife because they didn't have that capability before.
Okay. Okay, committee, any questions?
I almost feel like I want a slate of candidates. Just give me the slate. And I'm gonna vote for them.
All right.
That way you got all it, just give me the slate and I can be like, yeah, I'm down with the
Yeah.
slate.
I do have a question. So how does that affect management or liability or, since they're moving to another banner, you telling me that the same people who are gonna be running the small cap are moving to MetLife?
That's correct.
But MetLife is now gonna be our manager?
That's correct.
So,
That's
so,
correct.
and your due diligence on MetLife is they're a strong firm,
Yes.
large bench, large, deep pockets.
Yes.
Okay, more buying power.
Yes.
Okay.
MetLife is significantly larger than Mesirow. And again, this strategic acquisition is also part of another acquisition that they made. There's another firm called PineBridge that they also have announced that they're acquiring. So yeah, MetLife, we view them positively. They've always had a very strong fixed income bench. This now puts them in a more competitive position where they're now acquiring strong equity products so they can compete with other firms in the marketplace. But they are a big player, big pockets. It's an insurance company. And, with insurance company, there's that conservative way of looking at the world and managing money.
Okay. So in reference to one of the action items, it does reference accepting the recommendations from Marquette. So would you proceed to give us your slate in reference to your recommendations?
Sure, and definitely as I go through this, I want to just kind of quickly just recap on the points that tilted certain managers to one's favor or not.
I would appreciate
Ask
that.
that you give me the slate first and then go to the explanation second, because I just want to make sure I understand the actual recommendation.
Sure.
Then I want to understand the why after that, just to make sure I can keep it straight in my little brain.
Sure, absolutely.
Okay.
Absolutely.
By category.
So with fixed income, we are looking at Loop Capital.
They want to change it.
Okay.
For mid-cap, Earnest Partners. For small cap, Mesereau and Channing, but Mesereau will become MetLife as of February this year.
Okay. Okay.
International emerging markets, we're looking at GQG. And then international small cap, we're looking at TS&W.
That matches up to what I remember. So.
And fixed core, fixed income
I have
core.
a question. You picked the underperformer in 1, 2, 3 of the categories. So Loop underperformed Ramirez, and you picked Loop. Ernst Partners underperformed Madison, and you picked Ernst. And then Causeway underperformed GQ, whatever that one is, GQG. So I'm just wondering why you would pick the underperformers, because the whole point of the pension is that we have it perform to support our workforce.
He picked GQG. He picked GQG. He didn't pick Madison.
Causeway, he picked GQG.
You picked
over
GQG, yeah, and didn't Causeway outperform?
I'm going back and actually pulling the performance now.
What measure are you using?
I was using their returns over 10 years.
10-year return?
Yeah.
Okay.
Yeah, so GQG, GQG has outperformed all of the managers. So I'm going off the search book. This is off the packet that we had. And what I'll do is call out the numbers and the pages in the search book.
Okay.
But GQG, they've been a strong performer. They have a 7+ year track record. The lead portfolio manager, Rajiv Jing, came from a firm called Von Tobel, so he has an even longer track record. But of the performers, for example, the 3-year number when we were going through the report for GQG was 4.1 positive. For Causeway, it was negative 1.3. The 5-year was 9.9 for GQG, 5.6 for Causeway. For the 7-year, it was 9.8, and it was 4.6 for Causeway. Causeway does have the 10-year track record, which which GQG doesn't. But Von Tobel's track record was stronger over that 10-year period. So GQG is the stronger performing candidate. I will now jump into fixed income really quickly. So I'm going to go through everything and just kind of explain the rationale here. And part of this is also on some of the talking points and discussions that we had. But the goal here, again, is going back to, we're picking good managers across all the candidates, and we think that all the candidates will do an exceptional job. So with international small cap, TS&W, their 3-year return was a plus 1.9%. SGA was a negative 1.1. TS&W 5-year was a plus 7.9. SGA was 4.6. 7-year for TS&W was 6.4 positive. SGA was 3.3. And then 10-year for TS&W was plus 5.5. SGA was 4.1. So
Yeah, they outperformed. But
TS&W has outperformed there.
4+ in the mid cap, you did not pick the top performers.
And then, so I do want to mention here that it's also looking at who's going to complement the benchmark, who's also going to protect on the downside. But let me just go through those numbers very quickly and also just explain, the rationale that we went through. So there's definitely numbers and exhaustive conversations we had to kind of get to the conclusion. So I just want to make sure that, there's a consensus here that everyone, again, is a good manager. Ultimately, there's going to be different styles. Some may be more in favor than others. With Ramirez, their muni exposure definitely has been advantageous, but I know during the discussion, their muni exposure was one of the things that we did discuss, and it wasn't necessarily that huge deciding factor. But as we go to the performance between, let's see, Loop and Ramirez, so this again is in the search book. This is in the packet online. Loop has a 3-year track record, and this is as of this is using September numbers from last year. Loop was down 2.4% over the 3-year period. Ramirez was down 2.7. 5-year Loop was up 60 basis points. Ramirez was up 20 basis points. 7 years, they're tied. And then over the 10-year period, Loop did return 2%, Ramirez 2.2%, but that 20 basis points differential, we'd say that that's not, so significant that we should pick one over the other. 2.2 versus 2%, both managers are basically in the ballpark with each other when we think about Loop and Ramirez, and then factoring in the performance around and exposure around municipals, that did factor into the decision. The other thing I want to mention here is the calendar year returns. So if we look at the calendar year returns, these are the batting averages for the managers. The calendar year returns, you're going to see that with Loop, there was actually a little bit more consistency with the batting average. So, in certain years, let's see, where Loop held up well, let's see, 2020, Loop was up 8.1%, Ramirez was up, but up 7%. 2019, Loop was up 10.2, Ramirez was up 9.6. So, again, we're looking at two very comparable managers as opposed to one manager that's really awful and then one that's significantly better. That's how I look at it. And again, the discussion around municipal exposure, I think, tilted it more towards Loop. But at the end of the day, both of these managers were picked because they would be very good complements to Fidelity. And ultimately, Loop is a strong candidate that would be a good complement to Fidelity. But with that being said, I do want to pause it since there was a question and just make sure that there is comfort level with the direction that we wanted to go here. Over 10 years, it's a 20 basis point differential. Over all other periods being measured, both managers have very competitive track records with each other when we're talking about the core fixed income strategies.
Could I offer that in equity, that absolutely matters for someone like me, right? Who's the outperformer, right? Let's take a look. In income, I want to see, it's just my style, who protects me in the down market? Ramirez outperformed Loop in every down market. And so they didn't sink us lower. For fixed income, that was important to me. And so that was why I landed on Ramirez for fixed income. I would take the same approach that you're saying, look, who had the strong performance? That's how I'm looking at equity. Let's start there. But for fixed income, and Kwaku, this is coming from retail experience, right? Not institutional. And so it may be a completely different philosophy, but I just wanted to share that thought process to offer, but I do like that there's no wrong answer here. So these are all solid, and I'm glad we had some good choices to pick from.
Yeah.
Any other questions? Okay.
Okay, and then there's just two more to, let's see, one more to go through. I just want to go through mid-cap really quickly, just a comparison of performance there as well on the mid-cap side. And then that way, if there's any questions, we can go through those as well. Okay, so for mid-cap, here we go. So we have Madison and we have Earnest. So for the 10-year period, you're looking at Madison with a return of 11.4%, Earnest with a return of 10.4%. So Madison has outperformed over that 10-year period. And then as we look at the 7-year, as well as the 5-year, as well as the 3-year, we are looking at Madison with a really strong track record. They have outperformed Earnest over those periods. I know during the discussion that we had, and again, we can revisit that, Earnest did talk about, their quality tilt their exposures within the portfolio, just a quick comparison of the top 10 names. You're going to see, let's see, with Earnest, who do they have? CBRE, Progressive, Insurance, Raymond James. So their financials exposure would have been a relative detractor. And then you look at someone like Madison. There was a discussion around, okay, they've got Ross stores, they've got Dollar Tree, so they're doing well right now. But I don't think, if I'm paraphrasing correctly, I think there was some concern that some of the portfolio holdings at Madison, given where the economy was, wouldn't necessarily be conducive to that same performance going forward. So really just weighing everything that the trustees said, looking at the fact that we're still going to have index exposure, which is the manager that's going to protect on the downside if there is going to be a sell-off. So ultimately, Earnest Partners, they're a good manager, as I said. All the managers we picked are good managers. Earnest has lagged Madison, that is correct. So deferring to the trustees once again, just to kind of make sure we're on the same page. If it's around the previous performance, Madison is the top pick. If it's around going forward, who you expect to protect on the downside, I know that there was some consensus around Earnest being the choice. So again, I kind of want to defer it to you guys a little bit just to make sure that nothing is lost in translation or in that conversation.
And what do they have now? Because they're already part of our portfolio. So what do they manage now?
So they have non-US large cap international. So they manage an international portfolio for us. And I don't have the 12/31 numbers, but as of November, they managed 47.5 million. And from a performance standpoint, they've actually held up pretty well. So since July of 2010, their since inception number is 6.9% on the international side. The index is 5.9. They had a pretty strong month, and we can go through that when we go through the performance. They were up 40 basis points. The index was down 90 basis points. So that does kind of go back to their return pattern recognition. In in certain markets, they're going to protect on the downside. Other markets, they're going to lag the index a little bit. But they've outperformed on a since inception basis, and same process, same methodology as you think about how they manage the mid-cap portfolio.
Any other questions? Okay, we have two other presentation items, then we'll get to the action items. So Kwaku, with regard to item B under presentations, the executive summary.
Sure. So for the executive summary, this is the November market tracker. And, what we'll point to here are pretty good results for the month of November. December was a slightly different month, so we'll see the market sold off in the month of December. But the month of November was really, really strong. We had the election. I think the market was essentially pricing in some degree of uncertainty. Would it be a contested election? Once the election wasn't contested, the market did rally just based off some of the pro-market policies that were discussed on the campaign trail. And then we saw an interest rate cut. So interest rates went down 25 basis points. Rates coming down is typically a positive thing for fixed income. So we saw fixed income up 1.1% for the month of November. U.S. equities also had a really good November. The election, as well as interest rate cuts, were a pretty strong tailwind for that segment of the market. Mid-cap growth in particular had a really good month, up 13.3%. But across the board, looking at really solid results for the month. Year to date, looking at very solid returns across all segments of the U.S. equity market. If you think about certain segments, and they were referred to as laggards during the year, the Russell 2000 value is referred to as a laggard, almost 18% through the end of November. So, If those are laggard years, I'll take those years all day, every day. So definitely more of a speculative environment we're in 2024. Technology definitely drove the returns of the market. The so-called Magnificent Seven, the NVIDIAs, the Metas, Teslas and so on really led the pack. Fast forward to right now, and as we start going through 2025 performance, I think we're going to see a little bit more volatility. The market is bracing itself for what the new normal may look like from the incoming administration. I think a few dozen executive orders are essentially being teed up for January 20th. We're thinking about tariffs potentially, the trade wars, and then geopolitically, which countries are going to act up and try and bait the U.S. This happens anytime there's a new administration. So all of that's leading to volatility that's taking away from these really good results we're talking about now. But going back to 2024, where the markets were a safer place for investors, this was a really, really good period of performance. November was a really good period. The international markets also held up pretty well through the end of November. More volatility came in the month of December, and again, concerns around tariffs, destabilizing trade. The irony here is if we end up having tariffs, international trade's more destabilized. The dollar typically strengthens. When the dollar strengthens, we become more expensive, and ultimately the results of the non-US market lag more. An example of that would be a comparison of the local EFI index versus the EFI index, just to give you a sense of how currency impacts things. So the local EFI return is the return in foreign currency terms. You then translate it to US dollars, knowing that US dollars cost more per unit than foreign currency. And a negative 1% return, for example, becomes negative 6. A positive 60 basis points becomes a negative 60 basis points. A positive 10.8 becomes a positive 6.2. So as we think about the impact of a trade war over the short term, that's the impact we expect to see on the international markets. So perhaps a little bit more volatility in the international markets in the foreseeable future in light of a pending trade war. But the international markets through the end of November, just going back to 2024 again, they were in pretty strong footing, high single digits. Currency and relative weighting of technology did lag the international markets relative to the US market. So that explains the differential in the performance of the US market versus the international market.
Quick, in thinking through that, what's really interesting is so this administration, even more so than some others, is definitely trying to pick winners and losers. There are people that are on the in crowd, I think, are going to have favorable policies towards them, and people that are on the out crowd won't. You saw this represented by, I think they've already said they're going to go after the loan package that Rivian got from the government, because Rivian is a major rival of Tesla. And so it's like, so it makes me confused as to how to interpret technology, because technology as a whole has a lot of things going forward, but they're trying to pick who's going to win technology. So that's going to make it a little bit murkier. How do you account for that so we are protected? Because it might be a big win, it might be just.
Yeah, I mean, I would say, I think in all of this, right, if we look at, there's going to be positives, there's going to be negatives, but if we look at the positives, I think ultimately, when we think about technology and we think about the US and technology, we're in, there's no longer the arms race or the Cold War. It's more who's going to win AI, who's going to win the technology race. So I think as Americans, it's a positive to know that there's going to be big winners, right? And those big winners will constitute investments in the S&P 500 and other indices that we have exposure to. I would say that, if you look at, any type of economic system, whether it's in Asia, whether it's in the US, there's going to be a little bit of, no one's going to explicitly say it because we're capitalistic and the government shouldn't intervene, but there always has been, whether it's the motor companies where you needed government intervention to come in and help the motor companies, right? It favored some companies over others. With the banks, you needed the government to come in, prop up some banks, and others failed. So I would say that this is part of a pattern that we've seen before. It's just going to be more bombastic, more in our face than probably we've been used to. But again, the government typically will pick its winners and losers. We just typically kind of carry on and don't really pay attention to that because it shouldn't be happening. As we look at the global equity markets, again, pretty good run through the end of November, but we'll see as December numbers come in, some of those pretty nice gains were given back towards the end of the year. So your strategies that lean more towards lower volatility, more towards defensive sectors are going to hold up pretty well as we think about volatility in the international markets. Real estate, this is one area that we'll discuss in 2025. It's an area where we have exposure through REITs. So we have listed exposure to real estate, the daily traded stocks of your real estate companies. That's presently where we have real estate exposure. We're still looking to invest in private real estate as well as infrastructure. So that's something later on this year that we'll look to discuss. And the goal there is to add additional diversification to the portfolio. When we think about the equity market selling off, the fixed income market going through volatility, real estate, infrastructure, these would be areas that would smooth out some of the returns of the traditional markets. Now, with the real estate market, that's definitely gone through its rotation following the COVID period. Office space in particular, back to work, meaning many different things for many different companies, has led to a depression of prices for office space. And then when we saw interest rates go up exponentially in 2022, that also dried up liquidity in the real estate market. All of a sudden, transaction activity was not at normal levels. And like with anything, right, if there's a supply and demand imbalance, pricing can either work in your favor or out of your favor. And in the case of real estate, because there was more supply than there was demand, given where interest rates were, high interest rates mean it's going to be more expensive to acquire these big properties. We saw pretty significant discounts being applied to real estate over the last 18 months or so. Because rates have come down, transaction activity has actually eased up a little bit. So we're actually beginning to see valuations trend the right way when you think about holding a real estate portfolio. So that's where we are in the cycle with real estate. And this continues to be an area that we think that having some exposure to should help us from a diversification standpoint.
But since they've announced that it's not trending down, it's volatile, and it will be for the entire year most likely because it's back up past 7% for standard. I mean, do we anticipate there's going to be major changes, or it's going to be kind of like it has been last year?
So I would say with real estate, so the type of real estate we're looking at is your core open-end real estate. So these are your large real estate properties that they may move in slightly different cycles to like the residential real estate market. So the residential real estate market, for example, is going through a huge amount of volatility because mortgage rates, 30-year mortgage rates are going out to 7 years, 7% plus, as an example. Financing.
And we're undersupplied.
Pardon?
And we're undersupplied.
Yes.
And old people are not moving out of big houses, so young people can't buy big houses anymore for their growing family. It's insane.
Correct. Because
It's insane.
Especially here.
technological advances in medicine, people are living longer, they're not necessarily downsizing, and so on. So on the residential side, there's a different dynamic there compared to your institutional investors in real estate. Your institutional investors in real estate, your hotels, your retail, your industrial, let's pick industrial as an example. We just spoke about, the tech race, Amazon, a really good example there. Amazon has continued to be, I think, just part of everyone's day-to-day life, logistics centers and so on. That's an example of something that's going to move counter-cyclically to the residential market, as an example. Multifamily, because less people are buying houses and more people are still renting, multifamily continues to be very attractive. So of all these sectors mentioned here, the one that's seeing pressure is office. But even with office, it depends on how you look at it, which lens you look at it from. So on the one hand, if you are a real estate manager that is doubled down on office and all your mission is to do is manage office properties, you're gonna, go through some challenges. If you are acquiring properties in good areas, prime locations, suddenly those office locations that are selling at huge discounts, they could be reappropriated into something else. The housing that we just mentioned that's undersupplied, all of a sudden there's more multifamily. All of a sudden it can get reappropriated into logistics centers, data centers. So when we were talking about technology winners and losers, the reshoring of jobs back in the U.S., there's definitely an undersupply of data centers in the U.S. So do those office spaces get reappropriated back into that? So definitely we're seeing, once again, they've always called it a K-shaped recovery, right? Like the letter K, you have one part going really, really high, another part going really, really low. So what we're seeing in the U.S. is that K-shape where certain segments of society, whether it's companies, whether it's individuals of a certain income or tax bracket, they're doing exceptionally well, and then other areas are not doing so well. So as part of the K-shape, I would say this type of real estate investment, the open-end, large, prime, well-leased, good tenants, long-term leases going 10 plus years, we expect this part of the market to do pretty well, particularly as interest rates come down. And as interest rates come down, you'll see that income is a steady component of return for the Odyssey Index, ODCE. That's the Odyssey Index that represents the large institutional investments. Anything that has an income component in a falling interest rate environment, it's going to see an appreciation in value just from how the discount model works. So this type of real estate, once again, should hold up pretty well, even though you correctly noted on the residential side, I think we are going to see some more pressure. You're going to see a huge supply and demand imbalance, and then certain markets are going to continue to trend really well. And then just throwing, another wrench in everything. LA, we've got the fires there. There's going to have to be a lot of rebuilding during a period of tariffs. Like that's going to be inflationary on the housing market, right? We would think. So a lot of unknowns, but going back to the industrial side of things, the industrial side of investing in real estate, that's actually poised for pretty good things from our standpoint.
How about insurance? When you talk about LA insurances, and does insurance only affect the residential, or does it also affect office and retail?
So all of these properties are going to be well leased, highly insured, but as it comes to insurance policies and premiums and the cost of those, as with every natural disaster, you're going to see those premiums jack up, and you're going to see the insurance component erode some of the returns we can expect going forward.
Quickly,
Realistic.
you referenced back to work.
Yes.
Could you expand on that?
Yeah, absolutely. So or I should say during the COVID era, and it's weird, it was 5 years ago, right? It's this very surreal time thing that we're in. But 5 years ago, around March, the world shut down for around 2 years. And a lot of people got used to working remotely. We had people coming into the workforce for the first time that didn't even know what an office was. So this hybrid type of working became more popular. It was a good retention tool. And I'm firmly Gen X, so I grew up probably a little bit too, I don't know, we just worked through stuff, right? My parents were from a different era, and we just got stuff done. Gen Z, I would say that they're more open to negotiating. It's really about the work environment and their feelings and how things work out for them. So employers, to make sure that they were bringing in young talent, were also very mindful of the demand for hybrid schedules. So a lot of folks didn't work in the office. Now we're seeing across the country, some companies are fine with remote working, because at the end of the day, if you have adults that are entrusted to do a job, those that do a good job will get rewarded. Those that don't, they'll get replaced by those that do. You also have certain business models or certain firms that want to make sure people are back in the office. They don't think working remotely makes sense. And right now, this is part of, I think, a cultural discussion or cultural divide that's taking place in the country. So certain firms have people back to work 5 days a week. Certain firms have people on a hybrid schedule, and then others are fine with having some colleagues remote. And ultimately, that's impacted the demand for office space.
Okay.
Infrastructure, this is a subset of the real asset space. So some of the points I made around real estate also pertain to infrastructure. Infrastructure is an area of the market that we expect to hold up well over a full market cycle. And like real estate, these are your hard physical assets. There is an income component to the infrastructure investment, but ultimately, unlike your office space, infrastructure, these are essential goods and services. So you can think about your airports, your power grids. The managers we invest in, they don't invest in prisons, or they're not looking to make money off dubious means. You're looking at hard infrastructure as opposed to anything else. Private equity, this is an area that we have exposure to, and this is an area we expect to continue to hold up well for our clients for the foreseeable future, particularly as we see more volatility from the equity markets. And then private credit, this is a subset of the private markets. Private credit may be in some of the fund-to-fund exposure, particularly as Mesirow is deploying the portfolio. Private credit is just a nice way of getting yield, liquidity, and getting the money to work pretty quickly on the private market side of things. But from a performance standpoint, you can see here performance was really good for the month of November. Portfolio was up 3.4%, index was up 2.5%. We were up 14.6%, so close to 15% through the end of November. Index was up 12.9%. As we look out to the right-hand side, really good results as we think about the overall performance of the portfolio. Portfolio has held up really, really nicely. You'll see that private equity, there's an underweight there because it's going to take a while for the money to get deployed. So we'll have overweights in equities. As the money does get called for private equity, we'll pull back from our traditional equity. So those overweights should continue to come down on the equity side of things. This page just shows the managers and how we're allocated across the various managers. And as mentioned earlier, we have liquid exposure to both real estate and infrastructure presently. The goal would be to look at private market exposure in these areas of the market, just to, again, dampen some of the volatility that we just discussed. As we look at manager performance really quickly, the index funds, and this is the beauty of index funds, they're going to perform as well as the market. In an up environment, that's a great thing. What we're seeing in 2025 is the market selling off. So it's that reminder that the timing of looking at some of these active managers, I think, has come pretty well for us. But through the end of November, market was up tremendously, and we're participating with that upside. Ernest Partners, we just mentioned their performance here. So pretty nice results going to since inception. So that's an active manager. So just wanted to highlight that. Fidelity, this is also an active manager in the portfolio. So the goal here would be to have the active manager we pick to complement that Fidelity allocation. Out of prudence, just having all of our allocation with one manager, all of our eggs in one basket. We now have 2 fixed income managers, or will have 2 fixed income managers. So again, we anticipate some pretty nice results in both up and down environments from the complementary nature of the managers that we're looking at versus Fidelity. The REIT fund, the infrastructure fund, both of these holding up well. And all in all, pretty good results when we think about the month of November. Going to fast forward really quickly to December performance. So December, as mentioned, more of a volatile period. Market was down 2.4% for the month as we think about the S&P 500. Russell 3000, which incorporates mid-cap and small-cap, was down a little bit more because mid-cap and small-cap were down more than large-cap. For the year, it was a very strong year. So the market had a very strong 2024. But as we can see, for the 1-month period, the market did give back a little. Same can be said for fixed income. Same can also be said for the international markets. Certain components of the international markets did perform better in the month of December. emerging markets being one of them. Rates coming down, actually a good thing for emerging markets as we think about the currency effect and some of these countries being net debtors to the US. Rates come down, it's easier to service your debt that way. We continue to see the currency effect take hold, and we continue to see the US market dominate the non-US market from a performance standpoint. So the ACWI ex-US up 5.5%, S&P 500 was up 5 times, close to 6 times that multiple.
Blake, I had a question on that.
Yes.
Since we have Sango, can one of the regional areas that's reported be the African market?
Yeah, so and that's a really good question. So I would say on the one hand, there's two things we can take a look at. The continent, the countries that are being invested in, you can think about them in the emerging markets bucket or the frontier markets bucket.
Okay.
Frontier and emerging markets are going to have, I would say, less correlation once you take China out of the equation. Trade wars and tariffs, the countries that have been mentioned so far, Mexico, Canada, China. There's less direct exposure to those countries via, let's say, a Sango. But the one thing that we want to be mindful of is the currency effect. The currency effect over the short term, if the dollar does appreciate pretty significantly, that's going to be a headwind for a manager like Sango. But then on the flip side, Sango is essentially diversified with Mesirow. So Mesirow has the larger allocation when all is said and done in private equity that's dominated in US dollars. So that kind of offsets some of the concern there when we think about currency. And then again, this administration, if this incoming administration, if we think about Africa and its policies for Africa, last time around, Africa was kind of left alone, so I don't think anything would be different this time around, and I think that's a good thing when all is said and done, because if areas are left alone to their own devices, that ultimately you have areas of inefficiency that can be exploited by managers as opposed to large international companies coming in. So all in all, I think there's a little gray area, but I think it's not China. It's not, Latin America. So again, or South America. So those are things that work in Sango's favor. The one thing that could potentially be a headwind over the short term is the currency component of things. And that's something I would say for the next meeting, maybe what I can do here is, have an overview, a summary, outlook from the Sango team with respect to what they are seeing and hearing with respect to those questions, and then we can continue the discussion from there. But it's a long-term investment, so the good news is it's a longer-term investment. The short-term noise, some of that may be so short-term it doesn't even make it into the markups that we see. But ultimately, if it's more persistent in nature, I'll get a write-up and an overview from Sango, and we can discuss a little bit more at the next meeting. But really good question there. And I would lead with the currency being the bigger component of headwind facing that manager. So we can see here for the 1 month period, portfolio is down 2.8%. So as we think about the active managers we're putting in, the hope is, and the analysis kind of points to these managers helping. So if there's a sell-off, we would expect some of these managers to help protect on the downside. And then the more important thing is over the 1 year period, really solid result here. We're still up 11.4%. So it's still a really, really good year when all is said and done from a performance standpoint. So that wraps up the performance. This is the memo on Mesirow. So I just wanted to let you know it's here. It points to the reason for the transaction, points to the expected date of the transaction closing. We've mentioned here that we recommend placing the strategies impacted on alert. That's procedural because there's an ownership change when all is said and done. But we are still looking at recommending the small cap strategy. If we hadn't gone through the searches, we would have recommended going through a search and comparing Mesro to other firms. But that's literally what we did, and that's where Mesro on merit won the allocation in our opinion. So yeah, it doesn't change our recommendation for Mesro, which I think is now a good segue to the action item, if there aren't any other questions.
Right, we have one more presentation item, based on a request from, one of our pension committee members regarding COLA. And I think Gray has a proposed scope of work. Gray?
Yeah, thank you, Chairman. Yeah, just want to share with the pension committee, following up on the last discussion, we've worked with our actuary, Rudd and Wisdom. They've provided or offered to do a specific study on the COLA feature that is contained in the plan. The cost is about $10,000. So we plan to move forward with that to collect information, and have Mitchell Bilby come back and present. As you recall, what we have currently in the plan is based on CPIW for urban wage earners. So it's defined in the way the formula works. There's limitations with a 2% cap or the first $10,000 of benefits, or the age benefit. So each of those, were put in place historically, and this study would look at other plans, look at variations of modifying, one or more of those. So I'd like to just let the committee know we plan to get that study underway and offer, if the committee has any other input or would like to add to any of the suggestions, things to study specific to COLA, you could just let me know.
So great, they're gonna look at CPI, just give us a bunch of options for alternative ways to calculate. Are they also gonna then extrapolate what the cost would be?
Yes, yeah, under various alternatives.
Okay.
I'd just like to add, for the board, and it's not all pensioners, it's pensioners over ages 65 and older.
Mhm.
So it's not all pensioners, it's.
So is that something they're gonna be looking at too, or that's just it?
I don't think that part is included for pensioners younger than age 65, no.
That's something we've asked to.
Yes, yeah, the age component will specifically be included, and, but I
Because
guess
currently, only 65 and over receive the COLA.
comparison to, on the cost side, to expanding that, and then, if there's other pension plans that are similar, that have similar things, some of these things are done, I guess, purely for cost reasons, but again, just trying to be transparent with what can be adjusted, what's the resulting cost, and just have that for the committee to examine.
So great, I'm sorry, go ahead, Dexter.
You first.
There was one other population, the disabled population currently does not qualify. Is that a part of this analysis also? What it would cost for them to have COLA?
We can ask, I'm not familiar with that. Do you know, Stephanie?
So, I think we could ask,
Qualify.
especially maybe if we consider an age component, because sometimes we have disabled much younger than, but if we decide on the age 60, 62, or keep 65, if we include the disabled, then we could ask, I think, great.
Yeah, I'll ask on that.
Question. Dexter?
To clarify that, we're looking at, you said the COLA was based on urban something, I guess that was national, that we are now specifically going to look into Louisiana, something more conducive to what our retirees are faced with. Is that what we're doing? We're expanding?
Yeah, we're asking the actuary to provide an alternative that would be a more narrow measure, Louisiana, New Orleans. So yes, we can ask.
And my other question is it on the, I think, I just got this understanding that the COLA is based on the first 10,000?
Yes,
Are we asking to look at increasing that?
yes.
We are? Okay.
Great, I had a question.
Good point.
Would they be looking at our amortization schedule that we agreed to offset potential added costs if there's a change to the COLA
That
extension?
plan change, yeah, that would be impacted. So when you talk about financing it, then
Yeah.
you sort of get into that discussion of what what does it cost over the years? How does it affect the funded status? So that first step is sort of identify the features, quantify, and then that will be sort of a second set of analysis. Yeah.
What's the timeline on this?
I think it's maybe Q2, we can ask, it's a smaller size study than the one they just did over the whole experience study. So we'll follow up to get definite dates, but I think over the next 3 to 6 months.
Okay, thank you.
I think that would meet the request of the pension committee member who made that request. That timeline would be
Yeah.
a good one.
Follow up with that and, report back to the chairman.
Okay, thanks, Gray. Let's move to action items, and we're gonna take these individually, starting with the fixed income core plus investment strategy. So I need a motion to accept the investment consultant recommendation of Loop Capital. Is that correct, Quaco?
That is correct.
In the fixed income core plus investment strategy.
So moved.
We have a motion, do we have a second?
Second.
We have a motion and a second. Any questions? All in favor?
Aye.
Aye. Opposed? Motion carries. Second, motion to accept investment consultant recommendation for managers in mid-cap investment strategy. Recommendation from Marquette is Ernest Partners. Do I have a motion?
So moved.
We have a motion. Do we have a second?
Second.
We have a motion and a second. Any questions? Hearing no questions, all in favor?
Aye.
Opposed?
Aye.
One note, one opposed. Motion carries. Motion to accept the investment consultant recommendation for managers in small cap. We have two recommended, Mesereau and Channing. I have a motion to accept the recommendation from Marquette.
So moved. Yes.
So moved. Second?
Second.
We have a motion and a second. Any additional questions? Hearing none. All in favor? Say aye. Opposed? Motion carries. Motion to accept the investment consultant recommendation for managers in international emerging markets. The recommendation from Marquette is GQG. Do I have a motion?
So moved.
We have a motion. Do I have a second?
Second.
We have a motion and a second. Any questions? All in favor?
Aye.
Aye. Opposed? Motion carries. And finally, the motion to accept the investment consultant recommendation for managers in the international small cap investment strategy. The recommendation from Marquette is TS&W. Do I have a motion?
So moved.
I have a motion. Do I have a second?
Second.
We have a motion and a second. Any questions? Hearing none. All in favor?
Aye.
Opposed? Motion carries. Thank you, committee members. Informational items were in the packet. Any public comment? Any public comment?
No public comment, Chair. Did we receive any cards? No, no public
No
comment.
public comment. In that case, if we have no further business to discuss, I'll entertain a motion for adjournment.
So moved.
So move, second? Second, all in favor? Carries. Thank you.
Thank you.
Thank you, Quaco, as always. And
You're done.
you will have an agenda item for us with regard to Sango to follow up on Rebecca's question.
That is correct.
So we want to make sure that that gets on the agenda.
Yes.
Okay,
So I will follow up with Sango this afternoon